Hey everyone, welcome back. Today we're going deep into currency investing, using this really cool paper as our guide. It's called Common Factors in Currency Characteristics, and it's all about, well, trying to crack the code of how currencies move and maybe even finding ways to make some money off of it.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Yeah, you got it. Moritz Dauber and Dennis Umlandt, they're the authors, and they really went all in on the data, specifically looking at the G10 currencies, the big ones, the US dollar, the euro, the Japanese yen, all those major players.
Right, the ones we hear about all the time. But they didn't just stop at looking at them one by one, did they? They wanted to find some sort of secret connections between them all.
Exactly. And what's really interesting is they didn't just get stuck on interest rates, like how the carry trade usually works. They went way beyond that and looked at a whole bunch of characteristics, 9 in total.
9, wow. Okay, so we got interest rates in there, obviously, both the short-term and long-term kind, but what else did they throw into the mix?
Well, they included momentum, which is basically how a currency has been moving, like if it's been trending up or down, both in the short term and the long term. And then there's value, which is like comparing a currency's price now to what it used to be.
So figuring out if a currency's on sale or if it's overpriced based on its history.
Yeah, kind of like that. They even looked at a country's net foreign assets, which gives you an idea of how financially healthy a country is, like their overall economic situation.
So they really went all out, huh? Didn't leave anything out.
And that's what makes this research so cool. They didn't just get lost in all those tiny details about each currency. They used this powerful tool called a tensor, which lets you see the bigger picture.
Okay, hold on. Tensor, that sounds kind of scary. Can you break that down for us?
Well, imagine a massive spreadsheet, but it's not just flat. It's 3D. Each little box in this spreadsheet represents a specific moment in time. And inside that box, you've got data for every single currency and all those 9 characteristics we talked about.
So it's not just a table. It's like a whole cube of data with different layers showing you different parts of the currency market.
You got it. That's a great way to visualize it. But of course, these tensors can get crazy complicated, so that's where Tucker Decomposition comes in. It's basically like shrinking that giant data cube down to something more manageable, but without losing the important connections between everything.
So like compressing a photo. It takes up less space, but you can still see the whole picture clearly.
Exactly. And by doing this, the researchers found these really fascinating underlying factors, they call them Tucker factors, that really drive how currencies behave. They're like hidden patterns in the data telling us how all those different characteristics play together and affect what kind of returns we can expect.
And that's where the money-making part comes in, right? If we can figure out these Tucker factors, maybe we can use them to be smarter investors.
That's the idea. The researchers actually found that these Tucker factors can be turned into actual investment strategies. And some of them seem to work even better than those traditional approaches like the carry trade, in terms of the return you get for the risk you take.
Okay, now I'm really interested. Tell me more about these Tucker factors. What kind of secrets did they uncover, and how do they actually work in practice?
Well, let's start with the first one, Tucker factor number 1. It has this really cool connection to the good old carry trade. So Tucker 1, it's kind of like the carry trade, but with a fancy upgrade. Remember, the carry trade, you borrow money in a currency where interest rates are low and then invest it in one with higher rates. You're basically trying to profit from that difference.
Right, like buy low, sell high, but with money instead of stuff.
Exactly. But here's the thing. The paper found that Tucker 1, even though it acts a lot like the carry trade, it actually seems to be way tougher. It doesn't crash as often or as badly.
Oh, really? That's pretty cool because the carry trade, everyone knows, it can be super risky. 1 minute you're making money and the next, bam, everything changes and you're losing big time. So what makes this Tucker 1 thing so different? What's its secret?
It probably has to do with all those extra characteristics that Tucker 1 takes into account. It's not just about interest rates anymore. It's also looking at things like momentum and value, which basically means it can pick out currencies that are not only giving you good interest, but might also be undervalued or on the rise, you know?
So it's like a more balanced way of doing the carry trade. Like it's trying to smooth out the bumps in the road.
Yeah, that's a good way to put it. But here's where things get even more interesting. We got to talk about the second Tucker factor, Tucker 2. This one's kind of like a safety net for when the carry trade goes wrong.
So like if Tucker 1 is the one pushing you to go fast, Tucker 2 is the one telling you to slow down when you need to.
Exactly. You got it. And get this, the stuff that makes Tucker 2 work well is totally different from what makes Tucker 1 tick. So while Tucker 1 is all about those interest rate differences, Tucker 2 is paying attention to stuff like FX value, which basically means is a currency overpriced or is it a bargain? And also the term spread, which is the difference between those long-term and short-term interest rates.
Okay, I'm starting to see how these two Tucker factors can work together, like a team. But what about the bottom line? How did these strategies actually do compared to just doing a plain old carry trade?
Yeah.
Did they really make more money?
Let's dive into the numbers. They looked at the period from 2004 to 2023 using the G10 currencies. The regular carry trade, it gave you an average return of about 1.78% each year.
Not really that impressive, especially considering all the risks involved.
Yeah, and that's what we've been seeing in developed markets lately. Carry trade, it just hasn't been what it used to be, partly because interest rates around the world have been so low. But check this out. When they looked at just Tucker 1 by itself, the average yearly return jumped to 3.7%. That's more than double what you'd get from the basic carry trade.
Wow, that's a big difference. So Tucker 1, it seems like it really is a better, stronger way to play the currency game.
But wait, there's more. When they combined Tucker 1 and Tucker 2, they got a strategy that basically gave the same returns as the carry trade, but with a lot less of the ups and downs. Those big, scary drops, they didn't happen as much and they weren't as bad.
So you get the good stuff in the carry trade, but without as much risk. Sounds like a pretty sweet deal. But hold on, we can't forget about those other Tucker factors, the higher order ones. What did the researchers find out about those?
Those are definitely more complicated and they take a bit more brain power to figure out, but they're still super important. One of the most interesting things they found is that even though these higher order factors can be a bit unpredictable, some of them actually have really high Sharpe ratios.
And for those who don't speak finance, a Sharpe ratio is basically a way to measure how much bang you're getting for your buck.
Right.
A higher Sharpe ratio usually means you're getting more return without having to take on as much risk.
Yeah, that's the gist of it. So even though these higher order Tucker factors might be a bit tougher to work with, they could be worth the effort if you're willing to put in the time to understand them.
Okay, so we've got these Tucker factors, and they seem to be doing some pretty amazing things, at least based on what the researchers found. But how can regular people like us, individual investors, actually use this information? It all sounds kind of complicated.
That's the million-dollar question, isn't it? We can understand all the theory, but actually putting it into practice, that's a whole different ballgame. This paper, it doesn't really give you like step-by-step instructions for building a portfolio based on these Tucker factors, but it does give you a new way of thinking about currency investing, more sophisticated approach.
Okay, so let's talk about that new way of thinking. Where do we even begin?
Well, the first thing, and this is really important, is that you got to look beyond just interest rates when you're making decisions about currencies. Don't get me wrong, interest rates are still super important. They definitely drive a lot of what happens in the currency market. But this research shows that there's so much more to the story. Things like momentum, value, those global economic trends we talked about, those all matter too.
So it's kind of like, don't put all your eggs in one basket. You got to look at the whole picture, not just one or two little pieces.
Exactly. And that's really the biggest takeaway from this research. It's making us think harder about why some currencies are doing well and others aren't, and whether those trends are going to stick around or not.
So instead of just chasing after the highest interest rates, we need to understand what's really driving those rates and how things might change down the road.
Absolutely. And that's where those Tucker factors become super useful. They give us a way to see how all those different currency characteristics work together and how that teamwork, so to speak, can affect our returns.
Okay, I'm starting to get it, but how do we actually use these Tucker factors when we're making investment decisions? It still seems a bit fuzzy.
Well, you can think of the Tucker factors like different lenses you can use to look at the currency market. For example, let's say you want to try something similar to the carry trade, but you also want to avoid some of those big potential losses. Well, you might want to focus on currencies that are strong in Tucker 1, but also do well in Tucker 2.
So it's not like we're directly buying or selling based on the Tucker factors themselves, but we're using them to find currencies that have the specific characteristics that we're looking for, right?
We got it. It's all about understanding what really makes currencies move and using that knowledge to make smarter choices.
This has been super interesting, really eye-opening. But I think it's also important to remember that currency investing, it's not for the faint of heart, you know? It can be tricky. This paper, it's not like a magic formula that guarantees you'll make money. It's more like a powerful tool that can help you make better decisions.
Couldn't agree more. And it's also crucial to keep in mind that the financial world is constantly changing. New data pops up all the time, market conditions shift, and even the most sophisticated strategies need to be adjusted as things change.
That's why we always tell our listeners, do your homework, stay informed, and never stop learning. There's always something new to discover in the world of investing.
Keep exploring, keep asking those tough questions, and keep diving deep into those fascinating topics.
Until next time, happy investing, everyone.